Welcome to today's video, where we unpack whether you should pay off an inherited property or keep the mortgage and invest instead. To set the stage, we are focusing on high earners who inherit a primary residence with an existing mortgage. We will explore legal first steps, the payoff paradox between liquidity and security, ongoing affordability and hidden costs, and a practical asset audit to clear financial clutter. Along the way, we will discuss an actionable decision framework and run a numbers-based comparison to help you decide. Finally, we will share quizzes to check your understanding and highlight key takeaways. Let's begin. Here is our agenda for today. First, we will cover the legal steps around probate. Next, we will analyze the payoff paradox between liquidity and security. Then, we will evaluate affordability and hidden homeownership costs. After that, we will conduct an asset audit to prioritize financial health. Moving on, we will walk through a decision framework flowchart and a concise number snapshot comparing payoff versus investing. We will conclude with a clear action plan and a quick quiz to test understanding. Before we proceed, it is important to note that this video is educational in nature and does not constitute legal, tax, or financial advice. Your situation may include nuances related to state probate law, mortgage agreements, and tax status. Therefore, consult a licensed estate attorney, a tax professional, and a fiduciary financial planner before taking action. First, begin with probate to ensure assets and debts are properly inventoried and that the home's equity is protected from a forced sale to satisfy unsecured creditors. Work with an estate attorney to verify title transfer, manage creditor notifications, and continue making mortgage payments on time to prevent default. Additionally, be careful with inherited retirement accounts such as 401(k)s and IRAs. Distributions may create significant tax liabilities depending on the account type and your circumstances, whereas life insurance proceeds are typically tax-free to beneficiaries. The goal at this stage is to preserve the home's equity and maintain optionality while the estate settles. Next, review the probate timeline. Immediately after the owner's death, hire an estate attorney. Open probate and ensure that creditors are formally notified. Meanwhile, continue mortgage payments under existing terms to prevent any delinquency. Then inventory all assets and debts, resolve legitimate creditor claims, and complete title transfer. If applicable, you may assume the existing mortgage terms. Only after these steps should you make the final decision between paying off the mortgage and investing the funds. Now, weigh liquidity against security. If the mortgage rate is under approximately 5%, the opportunity cost of tying up cash in an illiquid home may be high relative to potential long-term market returns. Provided you maintain a robust emergency fund and have a multi-year investment horizon, investing in diversified index funds can be attractive. Conversely, if the mortgage rate is 5 to 6% or higher, the certainty of a risk-free or near risk-free return from paying down the debt becomes more compelling. Also consider that the Garn-St Germain Act often allows heirs to assume the existing mortgage without triggering a due-on-sale clause, which helps you preserve favorable terms and avoid refinancing costs. Avoid liquidating retirement accounts to pay off a low-rate mortgage due to potential tax penalties and lost tax-advantaged growth. Moving on, make sure the home is genuinely affordable. A property built around 1990 likely needs roof work, HVAC replacement, and potentially plumbing or electrical upgrades. Set aside 1 to 3% of the home's value annually for maintenance, in addition to property taxes and insurance. Remember, a paid-off home still carries ongoing costs. A dedicated sinking fund will stabilize your budget and prevent expensive surprises from forcing unfavorable financial decisions. Furthermore, conduct a thorough asset audit. Sentimental attachments often keep heirs holding on to high-maintenance items that drain cash. If there are multiple vehicles, retain the most reliable and liquidate the rest to reduce registration, insurance, and repair costs. Convert sentimental value to photographs and memories rather than ongoing expenses. Use the proceeds to strengthen your emergency fund and pay off any high-interest debt. Financial clarity increases flexibility and lowers stress. Let us compare paying off the mortgage with investing. Paying off guarantees a return equal to the mortgage interest rate, reduces complexity, and provides emotional relief. However, it concentrates wealth in an illiquid asset and may have a high opportunity cost if markets deliver higher returns. Investing, by contrast, can potentially outperform a low-rate mortgage and preserves liquidity, but it introduces market risk and requires consistent behavioral discipline and a sufficient emergency fund. Here is a numbers snapshot. Assume a 4% mortgage rate and a 7% long-term expected market return. Paying off provides a certain 4% effective return via avoided interest, but sacrifices liquidity. Investing yields an expected 3% spread over the mortgage rate, but with volatility and behavioral risks. Partial prepayment creates a blended outcome, preserving some liquidity while reducing interest. If the mortgage rate is 6.5% and your expected market return is 7%, the advantage of investing narrows, making payoff or refinancing more appealing. Now follow this step-by-step action plan. First, consult an estate attorney to open probate and protect home equity. Second, confirm whether you can assume the mortgage under existing terms. Third, list all debts and prioritize high interest balances. Fourth, build or top up a 6 to 12-month emergency fund. Fifth, estimate 1 to 3% of the home's value for annual maintenance and fund a sinking account. Sixth, audit and sell non-essential assets, such as extra vehicles. Seventh, if the mortgage rate is below 5% and you have adequate liquidity and a 7-year or longer horizon, consider investing instead of paying off. Eighth, if the mortgage rate is 5 to 6% or higher, consider accelerated paydown or refinancing. Ninth, avoid tapping retirement accounts for payoff without professional guidance due to tax issues. Finally, revisit the plan annually and after any major changes. Quiz time. If your inherited mortgage rate is 4% and you have a robust emergency fund with a 10-year horizon, which approach often makes more financial sense? Option A, pay off the mortgage immediately using all available cash. Option B, invest in diversified index funds while assuming the existing mortgage terms. Option C, stop making mortgage payments during probate to conserve cash. Option D, cash out an inherited IRA to eliminate the mortgage. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Option B. With a low mortgage rate, adequate liquidity, and a long investment horizon, the expected return from diversified index funds may exceed the interest savings from paying off the mortgage, especially if you can assume the existing favorable terms. However, this depends on risk tolerance and must be validated with a professional. Second quiz. How much should you generally budget annually for maintenance and capital expenditures on a 1990s home? Option A, 0.25% of home value. Option B, 1 to 3% of home value. Option C, only when something breaks. Option D, 5 to 7% of home value every year. You may pause the video now to consider the answer. We will reveal the answer in the next section. The correct answer is Option B. Allocating 1 to 3% of the home's value each year helps fund predictable maintenance and capital expenditures, which is especially important for homes built in the 1990s. As we continue, here is a practical checklist. Weekly, review cash flow and pending bills. Monthly, reconcile your budget and continue systematic investing. Quarterly, inspect HVAC filters and perform quick home checks like roof and gutters. Annually, reassess insurance coverage, property taxes, and your maintenance budget. Also annually, review your investment asset allocation and rebalance if your allocation drifts more than 5% from target. Additionally, consider the assumption pathway. Under the Garn-St Germain Act, many heirs are allowed to assume the existing mortgage without invoking a due-on-sale clause. This can prevent the need to refinance and helps you preserve a favorable interest rate, verify requirements with the loan servicer, and provide documentation quickly to avoid delays. This flowchart synthesizes the decision logic. Start with the inherited home and mortgage. Check whether the interest rate is below 5%. If yes, verify you have a 6 to 12-month emergency fund and a long investment horizon. If both are true, consider investing while assuming the mortgage. If your emergency fund is inadequate, build cash reserves first. If the mortgage rate is at or above 5 to 6%, evaluate refinancing or paying down debt more aggressively. A partial prepayment path balances liquidity and interest savings. The assumption option allows preservation of a favorable rate when available. Before we wrap up, let us recap the essentials. Begin with probate and protect the home's equity. Avoid rushing to pay off a low-rate mortgage if you already have strong liquidity and a long investment horizon. Budget 1 to 3% of the home's value annually for maintenance. Audit assets. Sell items that drain cash and prioritize high-interest debt reduction. Consider assuming the mortgage to maintain favorable terms. Finally, use a disciplined plan and review it annually. Thank you for watching. If this video helped you think clearly about whether to pay off an inherited property or invest instead, please like the video, share it with someone who might benefit, and subscribe for more content on building financial resilience. In the comments, tell us your biggest takeaway and whether you would pay off or invest based on your mortgage rate and time horizon. See you next time.